Two guys, same $50,000, same $55,000 salary, same city, same age, same starting line. One buys a rental property, the other buys index funds. 20 years later, one of them will have worked hundreds of hours for his money. The other will have done almost nothing. And when you actually run the numbers, the gap between what they think they earned and what they actually earned will make your stomach drop. Let's meet them. Michael takes his $50,000 and puts it down on a $250,000 rental property, a modest 3-bedroom in a decent neighborhood. 30-year mortgage, 7% interest. Payment, about $1,330 a month. He finds a tenant at $1,800 a month. Do the math in your head. That's $470 a month in pure profit. Michael feels like a genius. John takes his $50,000 and drops it into a total stock market index fund. Sets up $300 a month on autopilot. Never touches it again. His coworkers ask what he's investing in. Index funds, he says. They nod politely and change the subject. Nobody's impressed. Nobody ever is. Here's day one. Michael has a house, a tenant, and a story for the dinner party. John has a brokerage account and a confirmation email. It is not even close in terms of how it feels. But feelings and math are two very different.
The honeymoon phase. For the first few years, Michael is living the dream. Rent hits his account on the first like clockwork. He drives past the house on his commute and thinks, I own that. He's writing off mortgage interest and depreciation on his taxes. He's building equity with every payment. Comparable homes down the street keep climbing in value. Everything about it feels real. John logs into his brokerage app once a quarter. The number goes up a little, down a little, up a little more. Year 1, 50K becomes 55K. Year 2, maybe 61K. Nothing to see here. No key in his pocket, no tenant texting him at 10 p.m., just a number on a screen that refuses to be interesting. Michael's friends ask about the property constantly. John's friends don't ask him anything. And that social proof alone makes Michael feel like he's winning by a mile. He isn't. Not yet, anyway. Let's check the receipts. Year 3. The math doesn't lie. Michael has collected $64,800 in rent. His mortgage payments total $47,888. Gross cash flow, $16,920. Looks incredible on a napkin. Then reality shows up with a clipboard. Property taxes, roughly $3,000 a year. Insurance, roughly $1,500 a year. A new water heater, $1,200. A leaking roof, $2,800. 1 month of vacancy between tenants, $1,800 in lost rent, plus $600 to clean and relist. Michael manages it himself to save money, which really means 10 p.m. phone calls, weekend showings, and coordinating repairs on his lunch break. After every real cost, Michael's actual net cash flow over 3 years is somewhere around $2,000 to $4,000.
The part nobody talks about. The rent check is the number everyone brags about. It's the number on the thumbnail, the number at the real estate meetup, the number your landlord buddy shouts across the barbecue. What nobody mentions is everything that comes out of that check before you get to keep any of it. Vacancy. The average rental sits empty about a month a year. That's a full mortgage payment with zero income behind it. Maintenance. Budget 1 to 2% of the property's value annually. On a $250,000 house, that's $2,500 to $5,000 a year. Some years a $200 faucet, some years a $7,000 HVAC unit that dies in August when your tenant is already threatening to leave. Capital expenditures. Roofs last 20 to 25 years. Furnaces, 15 to 20. Water heaters, 10 to 12. These bills are guaranteed. They just haven't arrived yet. And they come in $5,000 to $15,000 chunks. Property management. Hire it out, lose 8 to 10% of rent every month. Do it yourself, and you're working a second job you don't get paid for. Bad tenants. The nightmare scenario.
A tenant who stops paying and knows the eviction process can cost you 3 to 6 months of lost rent, plus legal fees, enough to erase a year's profit in one shot. None of this shows up in the 400.
Year 10. Dead heat. Michael's property, worth $335K to $350K. Mortgage balance, roughly $166K. Equity, $170K to $184K. Total out-of-pocket beyond his down payment, after every real expense over 10 years, $20K to $35K. John's portfolio, $165K to $180K, on $86,000 total invested, $50K up front, plus $36K in contributions. The rest, pure compounding. They're neck and neck. Michael might be slightly ahead, thanks to leverage. But Michael also spent hundreds of hours managing that property, took on hundreds of thousands in debt, and bet his entire investment on one house in one zip code. John is spread across thousands of companies and hasn't lost a night of sleep over it. This is exactly where the story is about to break wide open. Year 20, the split. Michael's property, $450K to $500K. Mortgage nearly gone. Equity, $400K to $500K. Total net profit from cash flow after 20 years of taxes, turnover, repairs, and at least one big renovation, maybe $40K to $80K. John's portfolio, $420K to $460K, on $122,000 total contributed over 20 years. The other $300K plus, pure compound growth. No debt, no tenants, no 2 a.m. calls about a burst pipe. Net worth, basically a tie, somewhere between $400K and $500K each. But how they got there could not be more different. Michael worked for his. John waited for his. Michael carried stress, concentration risk, and an asset he couldn't sell in a weekend. John carried volatility, but also liquidity and freedom. And here's the twist that changes everything. If John simply... Fair's fair. Stocks have real risks too. If I only told you the downsides of real estate, I'd be doing exactly what every stock market influencer does. So let's be honest about the other side. Volatility is brutal. The market dropped 37% in 2008. It dropped 34% in a single month in March 2020. Watching $150,000 become $95,000 in a matter of weeks isn't a number on a screen. It's gut-wrenching. And most retail investors panic sell at the bottom, then buy back in after the recovery, locking in the worst possible outcome. No cash flow. Index funds don't send you a check. Dividends on a total market fund run 1.5 to 2%. On $150K, that's about $200 a month. Not exactly a paycheck replacement. No leverage. John's $50,000 controls $50,000 in assets. Michael's $50,000 controls $250,000. That 5-to-1 leverage is exactly why real estate creates more millionaires than the stock market in most wealth surveys. No tax magic. Real estate investors get to deduct a building's theoretical depreciation from taxable income, even while the property is appreciating in real life. It's a legal tax shelter stock investors simply don't get. When real estate actually wins. Real estate isn't the loser here. It's just misunderstood. It wins hardest when the rent-to-price ratio is strong. Monthly rent at 0.8 to 1% of purchase price. So the cash flow math works from day one. You treat it like a business, screening tenants, budgeting for capex, building